Hit it.
It's Friday, March 13th, 2026. Well, Kev, it's Friday the 13th. What can go wrong here, right?
Yeah.
Anyway, but episode 287, I'm Patrick Ceresna.
And I'm Kevin Muir. And with oil having the largest one-day moves in history, yet the stock market being relatively well-behaved, who do we turn to in this madness to make sense of it all? None other than our fearless technical leader, Patrick Ceresna. You don't want to miss this Talking Charts.
And folks, we might even drink some beers along the way. Danny, jump on here. Like, what beer am I drinking today?
Okay, well, this one's called Square Wheels. Never tried it myself, but apparently it's a wheat IPA with hops and hops to shine without finishing sweet, apparently. So got pineapple, juicy tangerine, fresh lime, and aromas, apparently.
Sounds terrible,
You know what?
actually.
For a 6.2% strong beer, it actually drinks very well for an IPA. But it is definitely bitter. Anyway, well, I'll give a rating at the end. Let's give it a go.
All right, Patrick, enough with the beer. You got something else, a big announcement. Why don't you tell people about it?
Oh, super huge announcement. No, but listen, actually, with these turbulent times in these markets, I can't think of a more important time for me to host one of my normal special webinars where I do for free, where I show people how to hedge their portfolios. And I can't think of a better time to do it right now with the way the conditions are. We'll talk about it during the Talking Charts. But listen, we're going to give also more details on it, but it is going to be on Monday, March 16th at 4 p.m. Eastern. And you can register for this hedging webinar on the bigpicturetrading.com website. We'll talk more about it in a moment.
All right. So for those who are interested and want to know more about hedging your portfolio, it's bigpicturetrading.com Monday at 4 p.m.
Nonetheless, Kev, give us some disclaimers here, buddy.
Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in this show. Side effects of too much huddle may include the oil floor repricing syndrome, the mid-70s accumulation urge, and the private fund gating panic.
All right. Well, let's get to the guest.
It's our great pleasure to welcome to the show Brian McCarthy. Brian is the managing principal for Macro Lens LLC. Brian, thanks for coming on.
Thanks for having me, Kevin.
It's going to be a lot of fun. We were chatting a little bit before the show. You're a Bostonian or someone that grew up in Boston. Growing up there, apart from loving the Bruins, did you always know you wanted to be into markets?
Yeah, I did. But by the way, the local term, I didn't actually grow up in Boston, so
you didn't.
More appropriate to call me a masshole. I was from
okay.
And you know, I not to date myself, but I sort of came of age in the 80s. I graduated Harvard in 1988. And, Wall Street was the place to go, right? What else?
Right.
That was sort of where everyone was heading. I landed on a trading floor at Morgan Stanley in the international fixed income department.
Okay.
And I've been in, what they call FIRC ever since. Fixed income rates and currencies are, sort of my area of expertise, global, of course. And, it's been a long, strange trip.
Now, did you go to school at Harvard? Did you study business?
Or I studied economics. Yeah.
It was economics.
I have an undergrad in economics, which I find sufficient.
Okay. And well, I have the same degree, and I always say I'm successful or moderately successful, despite having that. So you go to Morgan Stanley. So this is 88. So the crash has just happened. But the bond market is actually that's the start of a bull market, right? Like that's actually terrific timing in terms of the subsequent years of bond bull market.
Yeah, it sure was. It was a good period for fixed income. And the whole international thing was really just coming of age as well in terms of U.S. investors looking for diversification in global fixed income. And that was really, I'd say, the first decade of my career, really the focus. So again, I was in a research group at Morgan Stanley. And then I followed my boss over to what was then called Alliance Capital, now Alliance Bernstein,
Right.
and in an international research group there. And so I had early experiences in a bunch of crises, basically. In 1992, it was the ERM exchange rate mechanism, the precursor to the euro,
Okay.
blew up. They ended up putting Humpty Dumpty back together again, obviously. But Alliance Capital at that point had a lot of institutional clients in global income funds that were basically, FX carry trades
Okay.
that suffered a lot of volatility. So that was sort of early trial by fire. And then shortly thereafter, I went to AIG, the insurance company, and I managed a global fixed income portfolio for the insurance company. Lived through the Mex peso crisis,
Okay.
which was, another popular trade that, most of us had for income generating purposes that got pretty wild in 94 there. And
Right.
then at AIG, I ended up in the middle of the Asian currency crisis because AIG obviously has huge business in Asia. And as a global fixed income manager, I was on the foreign exchange committee with a handful of us sitting with the vice chairman, helping them decide what to do with the firm's foreign exchange exposures. And by the time I left AIT, my nickname was Mr. Bot because I sort of ended up in the middle of that. I'll tell the story if you got.
Yeah, sure. I'd love to hear it. I was going to say,
Interest.
yeah, for sure.
I was like, this time out, we had a huge exposure in Thailand. I'm like, this thing's gonna blow up, right? But interest rates, I don't remember, they were 19% or something. And these very senior guys at AIG were like, oh, we don't want to pay that. And I'm like, just whatever. 3 months is a quarter of 19%. If this thing goes, it's gonna go 30%. Like,
Right.
let's just hedge this. And they said, well, we don't want to pay that much. Well, let's only do it 1 month. Then we only have to pay, 2% or whatever it was. And I didn't really fight for the position because I was a junior guy.
Right.
And these guys were 35 years and hundreds of millions of dollars my senior. And I was like, okay. And I thought it was sort of a win. And our hedge came due like 3 days before the thing blew up.
Oh, come on,
And then
really?
when our hedge came due, now rates aren't at 19%, they're at like 19,000%, right? So we couldn't roll the hedge and then went into the event unhedged and got cratered.
Oh
So
my goodness.
I'm not exactly sure what I learned from that, other than I think really you got to stick to your guns when you have a strong view. And like I settled for half a loaf, and it ended up being worse than doing nothing, basically. So these things are tricky, but this is how we this is how we learn in this business, right?
Right. And I so many times I've seen people try to get cute with their hedge and save money, and it ends up costing you money. And one of the things that I've learned, like I grew up, I was an equity index derivative trader, and so I was always short those options. And in general, they were always like they would trade rich versus realized. So we would be short and we would make money. And then as I went on and matured to my own account, I've been hesitant to buy options. I always hated buying options. One of the things that I learned doing this show was I had guys like Morris Sachs and Jim Leitner on the show, and they would talk to me and they would say, no, you have to buy long dated options. And that was the one thing that really was kind of an aha eureka moment for me when I realized take away trying to time it perfectly because nobody does. And yours is the perfect example, and just
Right.
buy the long dated hedge.
Because the street, the investment management community is set up to sell vol, right?
Right.
That business, they're picking up you pick up the pennies in front of the steamroller
Right.
for 3 or 4 years. You get paid, and then the steamroller comes. Well, everybody else got steamrolled,
Yeah.
and then you do it again.
Well, I love telling the story of it was PIMCO's Bill Gross. He came out and he talked about how the Boone, when it was trading negative yield, he said this is a once in a lifetime opportunity to like short the Boone. He shorts the Boone. He's talking about it. He's like doing table pounding, and then he ends up losing money on the position because he got greedy and he did like a 1x2 or whatever, and because he was
Yeah.
All right, so you're there at AIG. You go through the long-term capital. What's your next move?
And then I moved to the sell side.
Okay. Oh,
I
okay.
went to Barclays Capital, and I was in FX sales, covering mostly asset management accounts and some hedge funds. And I had 3 stints in that gig. I did Barclays and then UBS for about 3 years, and then RBS for about 3 years. I did that
Okay.
for about a decade through the financial crisis. So I was at RBS in the financial crisis. I mean, to some extent, the epicenter, but what wasn't, right? Everything got smoked then, and that was obviously a wild experience. But pretty clear coming out of that the FX sales gig had changed in a pretty dramatic way. That wasn't going to be, the institutional sales, I think, across all product areas sort of in most cases aren't what they used to be.
Right.
And the business certainly isn't as much fun after the crisis as it was in the late 90s and the 2000s. So I was fortunate in that a gentleman that I sat behind at Morgan Stanley on my very first days in the business, a guy by the name of Kevin Kenny, had started a hedge fund. He was one of the first Tiger Cubs. So
Okay.
he was like a star at Morgan Stanley. He was running emerging markets there in his late 20s. And then Julian Robertson seeded him again, as I think it was the very first round of Tiger Cub funds. And his hedge fund was called Emerging Sovereign Group. And he hired me in early 2011 as the global macro strategist. They had a long short emerging market equities fund and a macro business. So I was the
Okay.
chief strategist for the macro business. And then in 2012, the Carlyle Group bought 55% of the firm from he and his partners. And they were very deep into China, a lot of PE business in China, great connections. And Kevin called me into his office. He said, we've never done anything in China macro. We have great connections through Carlyle. Why don't you go spend 6 weeks in China and come back and tell me what you think? And this was early 2012. So
Okay.
I did that. I came back and I went back into his office and I said, "Oh my God, this is the craziest thing I have ever seen in my life." And so that's now 14 years ago. And
Right.
it had, the telltale signs of a sort of a Ponzi dynamic then, in that they were, just complete and total moral hazard backing the financial system. So we started, I designed a single strategy fund predicated on the RMB blowing up.
Okay.
And Kevin was really like to sort of lever up these single strategy funds. When the RMB devalued by 3% in August of 2015, the fund returned 72% on the day. So I had that tiger by the tail for the next 3 or 4 years through a lot of ups and downs, at one point, I think might have been the biggest on the street in like 1 to 2 year dollar CNH calls, which, to your point about buying long-term options, by the way, 2-year dollar CNH calls are at all-time lows. Maybe discuss that later. Somebody wants a sort of a cheap hedge to put in the drawer. I know everything looks rosy in U.S.-China relations right now, but there's no guarantee that situation's going to last for 2 years. So at any rate, I sort of managed the ups and downs in that fund. But Carlyle just didn't really enjoy their experience with hedge funds. They bought 3. The other 2 fared really not well, and we were sort of
Okay.
treading water. So they sold the firm back to the founders, but they decided to shut it down in 2018. And I had basically, I think, had enough of like the Stanford train platform at 5:30 in the morning, and like
Yeah.
just had enough. Always liked to write, and the strategist role was where I really felt most comfortable. And decided to found Macro Lens in late 2018. Because of my sort of broad experience on both the buy and the sell side, had a pretty good sort of Rolodex of institutional investors, and I, provide institutional research and strategy on an independent basis, and it's both strategic and tactical. I write a note every Friday that's pretty extensive and put out a video to follow on Saturday. I'm in IB chat with a bunch of more tactical investors on a daily basis. So it's a sort of a real-time institutional research and strategy product.
Got it. And you got to move back home.
I did. Now I'm back on Cape Cod. The youngest went off to college, so we moved out of Stanford. No more of those trains, and now it's just a 5-month dark, cold winter. But we're coming out of that. So
Yeah, we gotta stay positive. Well, listen, I'm up here in Toronto. It just snowed, so just be thankful you haven't got that. Okay, so let's talk about what you think about markets. Obviously, what's on most people's mind is the Iran/US/Israeli war. Um, I don't know about you, but I've been really kind of fascinated about the fact that the market is being so sanguine about it. I don't know how to say that word, but just relaxed and hasn't really until this past few days been that concerned about it. Like if you look the first week, from Monday to Thursday, the stock market was unchanged. So
yeah.
first of all, do you agree that the market was very relaxed and did that surprise you?
Well, there's like relative pricing that doesn't make any sense to me. So
Okay.
obviously the oil market was not relaxed, which makes perfect sense.
Correct. Yeah, I guess that's true. Yeah.
Yeah. And then, but the bond market is also very not relaxed, and we can talk about that. That trade makes no sense. Central banks cannot be hiking into a supply shock. The economic logic of that, Econ 101, aggregate supply, aggregate demand says you're going to go into recession
Right.
if you do that. And if you have a sustained supply shock, real potential growth is going to be lower, at least as long as that supply shock is ongoing. And that suggests the neutral rate should be lower. So the Fed needs to make sure it doesn't tighten the monetary stance. And if we're still at war in 6 months, rates are going to have to be lower.
Okay.
That seems as clear as day to me. Not an easy choice because obviously there will be price pressures. But the reason the bond market has continued to trade highly correlated with oil, i.e., oil up, yields up, is
Yep.
because, to your point, the equities haven't freaked out yet.
Yes.
But my view is that if Trump, we're moving a marine amphibious unit out there. Now, I think it's posturing, but if he decides to take Carg Island or something, oil goes to 150. Equities aren't going to be down 2% then. I mean, this market is showing like the straws are accumulating on the camel's back. So I think if that happens, it's not my base case, but if that happens, you're talking equities down. We're going to have a 5% down day type of thing.
Right.
And then I think the market is going to wake up to the reality that a supply shock is, other things equal, contractionary, not inflationary. So get back to Iran. I hope you don't mind me bouncing around.
No,
a little
no,
bit,
no.
but we're on this supply shock thing.
Yeah.
I think the reason the market misreads this, two reasons. There's the oil crisis in the 70s.
Yep.
Yes, we had an oil crisis. Inflation was very high. Nominal GDP growth was 12% or something when that crisis hit. So
Right.
nominal GDP growth was double digits on average through the 70s. That was a demand problem exacerbated by supply shocks.
Okay.
Same with 2022. And I think we have a real problem analyzing this because the Federal Reserve had to cover their ass by saying it was a supply shock. But if you look at the trend of nominal GDP, it clearly was, by 2022, nominal GDP, it dipped in the recession, came back hard, but cumulatively on trend, it had gone much higher than the previous trend.
Right.
Clearly, there was a demand management error. They, in conjunction with the Treasury, did a big helicopter drop and they overdid it. Now, I honestly don't know why they didn't just say, yes, there was a demand error here exacerbated by the supply shocks coming out of the pandemic and Russia.
Yeah.
But let's just look at the chart of nominal GDP. We made a demand management error. It was a very hard thing to calibrate. I mean, I think it's sort of understandable. Was 2 trillion helicopter drop the right number? Was 4 trillion the right number? Nobody had any idea.
Yeah.
But it
Okay.
was the wrong number. And,
Right.
and then the less acceptable error, I think, was the the slow rate of tightening, the slow unwind of QE
Oh,
in
yeah.
early 20,
Well-
that was just, they were too slow. So they made a demand management error,
Yeah.
but because they'd rather not admit that, they just blame it all on supply shocks. And I think too many people have bought the idea that that was a supply shock. It was
Okay.
primarily a demand management error. And all I would say about the current environment is I don't think we have a demand management error. Nominal GDP growth has been very, very stable. Call it 5.3% final sales for 2.5 years now.
Yeah.
So the Fed actually has landed the economy.
Okay.
Now, we can talk about the administration's theory that real potential growth is much higher. I take issue with that. But 5.3 is probably consistent with core PCE inflation at 2.5 over time.
Okay.
Now, is that perfect? No, perfect would be 2, but we just went through the entire previous cycle at 1.6. So they did 1.6 last time. They do 2.5 this. It's close enough for government work.
Yeah.
But and the problem with these a lot of our friends on Twitter want to push it down to 2. They're not a 2. They're not a 2.
Yeah.
Once you've been at 5.3 nominal, let's say that's consistent with 2.5. So what is that? 2.8 real potential, which is maybe generous, but ballpark figures, right? To say I want to push it down by 0.5 point now to get it to a more inflation mandate consistent level, it's not worth the risk.
Right.
Because now you have a whole set of asset markets that are now priced to 5.3 because we've had that for 2.5 years.
Okay. I'm
Right.
with you.
So,
Right.
so the longer you price at a certain level, like in the last cycle, I don't know, what was stall speed? 3.5 nominal because we were at like 4.5, right? Now we're at 5.3. Stall speed's higher because you cut 150 basis points off nominal growth, and this bubbling problem in private credit's it's gonna be more than bubbling,
Right.
right? So just by dint of the fact that we've been running very stably, low vol at this rate for 2.5 years, I think you're playing with fire to try to push it a 0.5 point lower, because you hit feedback loops primarily via credit, and at 4.5 nominal, we're taking these equity earnings expectations down from 12 to 8 or 9, and it's not easy to like stick the landing a 0.5 point lower. The landing's been stuck. All right. They missed 2. It's at 2.5 equivalent of a nominal GDP run rate. Good enough. It's pretty damn good, I think.
Yeah.
It's not bad. So they've landed it without a recession. And, I think they just need to leave well enough alone now. Sorry, I got off on the Iran
No
thing.
problem. But so the reality though is that the front end of the yield curve is chasing oil higher. Like I made a chart and it was basically the December 2026 SOFR priced as a yield, and then I looked at it what year crude 1 year out, and it's almost following a tick for tick. So to some extent, like they've taken out 2 cuts out to December because of the higher oil, and so I'm with you in that I understand your argument that that's actually going to be recessionary, and especially if they don't go and do the cuts that they previously thought had been priced in, right? And
Yep.
so my question to you is, do we need to have an accident for those things to go back and to be priced correctly? Or will we get a situation where the bond market might go, hey, wait, you know what? The reality is that the cuts are still going to be on the table and they're probably going to look through a little bit of inflation. And, at the very least, we should put them back.
Yeah, I think the reality is we're either going to have an accident or Trump's going to smarten up and get the hell out of there in the next week or 10 days. And I'm not even sure he has a week or 10 days. And
Before the accident happens on a financial basis.
Yeah. Before we have a 6% down day.
Right.
I mean, this is like he's on the classic slippery slope. And I can tell you, I aired. So my client base, I have a lot of they're called pod shop guys.
Yeah, I understand.
And you really they really want to know what's going to happen in the next 2 days. There was a lot of money to be made or lost this week, right? What did we have? Almost a 2% day yesterday. You're on the wrong side of that. It's like you can get a tap on the shoulder at these places.
For sure. They're
right?
no doubt. They're trading extremely short term. There's no
Yeah,
doubt
yeah,
about
yeah.
it.
So that's the game, and even the asset managers are like, they're watching every wiggle. So you have to sort of get these things right. I didn't this week. I thought it would be over by now, and a very simple premise. Um, I think there's a red line on boots on the ground. Trump understands his presidency's over. I think when the moment the first boot hits the ground, I mean, it's insane. Um, if he gets sucked in like that, then we have huge problems. And if you're going to restrict your capabilities in that way, then you naturally have to constrict your objectives. So regime change was never a realistic objective. I think he figured they'd take a shot at it, but now both the U.S. and Israel are admitting that's not going to happen. Um, I think there was a window where what actually happened in the Oval Office or the Situation Room, I don't know. It does sound like they got the call from the Israelis. Hey, we got like 2 dozen of these guys in a room. We've had this on the drawing board. Let's do it. And then I think, in terms of public perception, get this concept that Hegseth presented early on of degrading the conventional shield behind which Iran was hiding its nuclear ambitions. All right, that was reasonable enough. Iran does not have a lot of fans out there, right? So that was reasonable enough. But as Trump himself acknowledged on Monday, which is now 5 days ago, that was done.
Yeah.
That was done. So you're never going to degrade their capability 100%. You're not going to get 100% of the missiles. So they're telling us we got like 90. Are we going to bomb the place back to the Stone Age to get to like 93? What are we
Right.
doing? So,
No,
like,
but
regime change is out. Trump told us today, the other fantasy, we're not doing Delta Force in there to get the uranium.
yeah.
What are we doing? What are we doing? So something happened this week where the president, I think, realized on Monday, we're hit diminishing returns here, right?
Okay.
This is now more risk than reward, because the risk that I've thought was he would understand all along, which is getting closer, is that you're going to force Iran into doing something asymmetric from which we can't come back.
Okay. But is it like I understand your argument, and I do agree that we're getting to a point where either the markets are going to freak out or he's going to pull back. But is he even able to pull back and have like the Strait of Hormuz open again? And that's really what I'm concerned about, is that in terms of when you're looking at the chessboard, it's not as easy as him just pulling back and saying everything's great. The strait might not open.
I'm surprised at the degree to which I'm now on the minority side of this. So I think over the past several days, a broad consensus has moved to the view you outlined, that Iran is not going to agree to a ceasefire. And the news flow does suggest that there might be back channel communications that aren't going so well in that regard. But I think it's all going to be worked out. I think it's all posturing. It doesn't make sense from the Iranian standpoint, as far as I can see, to continue. Now, a lot of this rests on one's assessment of who's actually winning, right? And, fog of war, propaganda on both sides. We don't know what we're not seeing. But I just look at, just what we do know is there are maybe 15 Israeli killed and 100 times as many Iranians. The Iranians haven't really hit anything that you would say, "Oh my God, that was wow! We didn't know they could do that," right? Um, so are we going to run out of interceptors? I don't have the intelligence on that, right? I'm sure there are people involved making decisions on both sides that have a lot more information than we do. If the administration went into this saying it was a 4-week thing and didn't have 4 weeks worth of defensive munitions, I'd be shocked and
Okay.
gravely disappointed.
So Do you worry though? Because I understand your argument, but what I'm concerned about is that seems to be a very popular argument, and it was very popular at least at the beginning of the week. As you noted, it's become less popular today. One of the things that concerns me is that yes, you'll get a pop in the stock market, and if you're correct, let's just imagine there is some sort of ceasefire. But I still worry that it's there isn't that much bad news yet priced into it, and that apart from playing the wiggle, that there's a lot of negatives that have been put into motion, and that we might get a situation where the economy rolls over anyways.
Oh yeah, sure, for sure, for sure. I mean, I think if there's let's say there's an agreement for a ceasefire, you're
Right.
probably going to rally 5%. I think it's probably a fade. I think the market was showing signs of stress. We've basically been range trading for 6 months in the
Yes.
major indices. Um, the Nasdaq has lost leadership. I don't really believe in the sustainability of this rotation trade. Um, because
Okay,
we
so
have
let's can you explain that? Because I think a lot of people were very excited about the rotation trade. It's been a tough week for them. Why don't you tell people why you don't think that that's something that people can really hang their hat on over the
well,
longer term?
Well, it's worked because we had strong data in the second half. But that data had a hell of a tailwind from this AI CapEx boom, which when we saw last quarter's earnings was revised up again. I mean, the revisions to the major hyperscalers AI CapEx in Q1 itself was like 40 basis points of GDP.
Okay, but why did that send people into value in small caps and the
Well,
things
I,
that
I I
hadn't?
think there's this reacceleration crowd, the sort of old economy cyclicals, and I
Okay.
think it's a weird confluence of I don't want to buy these hyperscalers anymore because of valuation, even though they're adding capex. So let's buy the economy because they're spending all this money and not have to worry so much about whether it's a good idea or not at these valuation levels.
But you
So
don't think that the real economy portion should be bought,
the next iteration is capex stops going up.
right?
Right? And I think we're seeing cracks in that story. The OpenAI's dropped news. I haven't seen anything yet today, but I think it's 2 Fridays in a row at like 5 p.m. They've dropped news that was not so hot. Right? Like one, they increased their revenue out for the next 4 years by like 29%. And also the cash burn was up by 112 billion, right? They dropped that. And then last week it was, this deal with Oracle at the big um, facility down in Texas is now on shaky ground.
Right.
So, there are questions starting to be raised as to whether at least whether this AI capex can continue to increase at the rate it has been increasing at, and I think not. Um, we did get a strong second half, really strong third quarter for GDP, driven again by this AI capex, but also a very surprising burst of experiential spending. So in the first half, we had leisure and hospitality and travel and restaurants, airfare, lodging, all softened in the first half, and it was a really, really strong third quarter.
Okay.
But I have a guest cottage on my property here that we rent out in the summer, and people book those things 8 months in advance. So you had a lot of like summer vacation spending that was robust in the third quarter. And I don't think that really tells us a lot about how people actually felt in the third quarter, right?
Oh, I see what you're saying. Okay.
So, not to discount that, it was a strong number. But we look until this morning, it looked like fourth quarter was another strong number. I think personal consumption was taken down from 2.4 to 2 real, and now nominal. It looks like that there's a bit of a deceleration again. So I look at the disaggregation of the consumption data, and it just doesn't look it explains the angst. While we have very strong headline growth, people aren't happy. And if you look at where the spending growth was last year, outside of that third quarter, which I think was pre-planned, the fun stuff actually was very weak. So
Right.
restaurants have been weak. Airfare, TSA throughput was up 0.5% 2025 on 2024. That's not so hot. We've seen Vegas had a terrible year, right?
Yeah.
So outside of the third quarter, spending on fun was lousy. You know what grew a lot? The bills. I call it the bills. Utilities, insurance, healthcare. And this is largely lagged price effects from the pandemic still, because these are the last things to adjust to the demand shock. The Fed makes a demand error. Commodity prices go up, goods prices go up. These services are the last thing because their cost base is wages and rents, which have natural lags built in.
Ah,
So,
okay.
Delta redid its contract. They got huge increases in like 2024 or something, right? So, so these services naturally lagged. We're seeing these latent price increases came through largely in 2024. And so people are spending more on paying the bills and spending more for goods because of some tariff price pressures, but they're not getting more goods.
Yeah.
So you're spending more on the bills, you're spending more on the groceries and your goods, but you're not getting more, and you're
Yeah.
going out to eat and you're going to be traveling less. So
What
this is the setup that just doesn't bode well for me.
when you tell people this, because this is very much non-consensus, at least in my interpretation of consensus, most folks think, oh, Trump tells us the economy is doing great. The numbers look terrific. It's all peaches and cream out there. What is the pushback like? What do they say to you when you try to say, hey, things aren't going as well as you might guess?
Yeah, well, I think the reacceleration crowd, um, that view is largely predicated on a view that the Fed is too easy, right? And I think this stems from the fact that inflation is above target. But as we discussed earlier, like they're in a steady state.
Right.
So yes, they're too easy in a steady state. That doesn't mean things are going to accelerate. And in fact, the jury may still be out on the 75 basis points we got in the fourth quarter of 2025. But this reacceleration crowd was screaming about the cuts in 2024 as being irresponsible. But clearly, that was the correct move. The neutral interest rate is falling, and the Fed has done a really pretty damn good job of marching the actual rate down in line with it. And we can say that again because nominal final sales, however you want to, whatever little piece of that you want to measure. I look at final sales to domestic purchasers, which strips out inventory and trade. And obviously, trade's very volatile, and inventories are always volatile. It's in a steady state. So they've been able to they've needed to cut rates to maintain the steady state. And I think we're going to find that that remains the case, and that the cuts in the fourth quarter of last year were the right move. Now, to be fair, if I were on the Fed board, I would be standing pat right now because we did have a strong second half. And I have a forecast that things are going to slow, but it's been steady for 2.5 years. So I'm normally an advocate of the Fed managing to a forecast. I think they did that aptly in 2024. I think it was the right thing to do it in 2025. But at this point, I don't disagree with those who say let's wait and see now a little bit whether we're going to get weaker data. And the weakness in the labor market is hitting us in the face as well. And I have been a big advocate of stripping out healthcare for 2 years now. Not stripping it out; those jobs are real; they happened. But there's a lot of funky stuff going on there. There was an elongated recovery from the pandemic job losses in that sector. And then there's something going on with this expanded Medicaid, which pays people to basically, take care of grandpa. And there's a lot of that going on. These generally aren't great jobs in terms of compensation for the most part. And outside of healthcare, we've basically had no job growth, none,
Right.
for a year now. So the other big debate is supply demand. And this gets back to not tightening into a supply shock. If the Fed says, well, labor supply is lower, so we have to let labor demand fall too, the break-even rate is lower. All right, fine. But that means aggregate income generation will slow, and it
Right.
has.
Uh,
And now you're taking us out of this 5-3 steady state, because we look at aggregate weekly payrolls, which is the monthly payrolls metric for aggregate income. It's total payrolls times hours worked times weekly earnings. So how much is that payroll report saying we're throwing off in aggregate income? And that's gone down from that 5.4 rate to the high fours somewhere. And now we have a growing divergence between income generation and spending. And again, these internals on spending tell me that the consumer is spending on stuff that's suggesting stretch.
right.
I surmise that that spending is going to slow with income. And so this is the Fed's dilemma in a supply shock. If you say labor market supply is zero, so we need job growth of zero, okay, well then income growth is going to slow to the rate of average hourly earnings. It's going to be 4 something. Spending growth is going to slow. Now you're risking hitting this stall speed, and maybe it's gradual enough so that's a couple quarters away. But I think this is the direction of travel, based on again, this slowing of income in the labor market, which I think is probably both supply and demand. But again, if it's supply, look, the whole idea of shutting off immigration, which whatever you think about Trump, I think this had a popular stamp of approval.
Yeah.
The whole idea of doing that was to increase wages for those who remain here. So, like, the Fed, in a way, is fighting that policy by not running it a little hot to bring those people into the labor market.
Yeah, that's a great point. Actually, I'm listening to you and I'm thinking about this one thing though. Look, you're definitely painting a picture of us at least slowing down in the coming months or quarters. And I was kind of struck recently with a conversation I had with one of my subscribers, and he was telling me how we don't have recessions anymore. We had the last recession that was a true economic recession was, in the 90s or whatever it was, because 2000 was the bursting of a dot-com bubble. 2007-8 was the global financial crisis brought on by the bursting of that financial bubble. And then 2020 was we shut down the economy for a global pandemic. Do you think that recessions are a thing of the past and that it's just going to be a slowdown, or do you worry that we will actually have a good old-fashioned economic recession?
No, I think, absent the shock, which we can now see might be brewing, right? Um, certainly if you can't get more than a few billion barrels of oil a day out of the Gulf for an extended period, that's a very significant supply shock. And I think what happens is, the process is there are just vulnerabilities that leave us vulnerable to a shock, and then a risk of monetary mismanagement. I mean, 2007 didn't have to become 2008. The Fed let demand collapse, basically, right? There was an error there.
You think it was the Fed? Because I'm not even sure they could have lowered rates quickly enough. Because wasn't the real problem that we needed fiscal and we were trying to fix it with a monetary solution?
Well, the aftermath,
Oh, I
the
see.
stagnation of the aftermath was, but the the Fed obviously made an error of overabundant liquidity that caused the problem,
Okay, I'll
right?
buy that for sure.
Right?
Yeah,
And then allowed a vicious liquidity crunch to unfold,
right. And
right?
you don't worry? Do you worry about that today? Like you brought up private credit and you brought up other sorts of exuberant market behavior. Do you think there might be something lurking out there like that this time?
My knee-jerk response was, I think Powell showed us in 2020 that he's learned that lesson. But then I realized, oh, wait a second.
Yeah.
Powell's going to be gone soon. And we got a guy who spent the last decade like railing about these policies taking the helm. So honestly, I think a Warsh-led Fed is going to be much more likely to make the error, even though he was there in 2008.
Yeah.
Um,
But by the way,
and you know, people rail about the Fed put. Sorry,
yeah.
like
No,
if,
go ahead.
if there's no two ways around it. If nominal activity is collapsing, they have to fix it because the system is just there's no self-stabilization down there.
Yeah. No, agree, especially because fiscal is so tough to do and it's slow to enact. And do you find it interesting though that you bring up Warsh, and the fact is the SOFR market is behaving like the Fed reaction function hasn't changed. And you would think, given that Warsh will be the chair at that point, and if he was going to be influential, that the front end of the curve wouldn't be moving. And
I
yet
think it
here,
makes a. I think the take on Warsh was right a couple weeks ago, which was he's going to be coming into a very contentious committee. And we are, for a while at least, going to be looking at a different kind of Fed that, you know, is not sort of bowing to the chairman as we've become used to.
okay,
I think that changes a little bit if we're still in some kind of oil crisis mess. Because if he gets there in June and, you know, S&Ps are 15% lower than they are here, and there's still bombs going off in the Middle East, and, you know, everything's a mess, I think there'll be enough uncertainty that the committee will not want to be bucking the chairman.
And do you think that Powell is going to be stubborn and not lower rates, just kind of a big FU on his way out? Because I've heard that argument that people say that really he should be lower, and he's been obstinate now, and absent Trump, the actually rates would be lower. Do you worry about that, or do you think?
Yeah, no, again, personally, I think on hold is the right thing for now.
Oh, okay. So you just think he's doing the right thing.
Yeah, yeah, I do.
But
And you know, so we downgraded the fourth quarter, but you know, we're probably, if Atlanta Fed is accurate, we're looking at 5.2 final sales again for Q1 right now.
Right.
Now we might get some downward revisions to personal consumption. You know, February retail sales looks okay. It sort of looks okay. So I think he's doing the right thing. But I do think there are sufficient vulnerabilities where if things go pear-shaped, they're going to have to be cutting, and you know, whatever, the inflation prints go out the window. That argument's going to have to be thrown out. And again, if S&Ps are down, you know, you get something like we saw last April in the equity market. Only it's not something the president can fix with a tweet. Then they're going to have to fix it.
Yeah.
And I think Powell would do that.
Okay.
In May,
agree.
like in May, if in his
Yeah.
last meeting, if the circumstances called for it.
So here's a question for you. Let's imagine we do get that scenario where he's late to get out of the Mideast. It continues to have problems. Oil stays up. Eventually, that creates enough financial pressure. We get a big down move in stocks, 10, 20%. He has to cut rates. What happens to the yield curve? Does term premium expand? Or we actually see for the first time people rushing back to bonds as like a place to hide?
Yeah. I still like the steepener, but it gets tricky in these situations because if the Fed lollygags, then we flatten and then steepen.
Right.
Like it needs to flatten like crazy to slap them into cutting, and then it steepens like crazy.
Right. But now do you think though, you say you like the steepener, let's just put all the kind of the media problems of Iran aside. Do you think that the term premium is something that's going to continue to expand in the coming, quarters, years?
No, I'm not. You know, I've been fighting this argument for 3 years. So I've been a bond bull since I don't know, 2 to 3 years.
Okay.
And the fact of the matter is, it's been a tug of war, right? We've basically been in a range trade. But I have been telling my clients every time we're pushing 5%, this is not going to break in that direction. It's not going to break in that direction. I don't buy the fiscal dominance arguments. I'm not overly focused on supply personally, because the term premium itself, there's only so far it can go. And ultimately, the expected path of short rates is going to be the predominant driver of where the long end goes, at least out to tens.
All right.
30s is a bit of a more supply sensitive animal, but at least out to tens. I'm not in the camp that there's not going to be buyers. There's always buyers.
So you were talking about the treasury curve. What about credit curve? So far, like up until 2 weeks ago, investment grade and high grade was actually really well behaved and some of the best performing stuff. We finally are getting some widening. Is this a result of the private credit, or is it them actually worrying about about the economy? And does it get worse from here?
I think it's the private credit spillover.
Oh, it is. Okay.
Yeah. And I'll give you sort of a weak call on whether it gets worse from here, which has been my weak call on equities for the last 18 months. As long as they keep nominal GDP growth at 5.2%, it's all going to be fine.
Okay.
Right? If the Fed doesn't make that error, you can't have big problems in credit, right? Some fund managers might have made some mistakes, or some sector might have a problem. But it's not going to be a macro credit event at 5% nominal GDP growth. And again, I think it's slowing gradually. My forecast for this year is they'll keep it at around 5, but it'll take 2 or 3 more rate cuts in the second half. It's pretty easily fixable, I think, as long as we don't get hit with the shock.
Right.
So
it's a slowdown, but they're gonna they're gonna continue to land the plane. Like the plane's just slowing a little bit, but everything's fine. We're not going off a cliff. Like he's
Yeah.
not driving it off a cliff. Okay, I understand where you're coming from there. In terms of China, let's talk about this, because most for a little while, your negative China view would have been very in fashion. Like for what it was, a couple of years there, was China was uninvestable. I remember looking at the EEM and then the EEM ex China, and the one with ex China was exploding at the expense of the EEM. That's changed recently over the last 6 months. There's been a much more of an appreciation and folks rushing into China. Do you think that's a mistake? And tell us if so, why?
Yes, I do. It's a narrative driven market. We've seen these types of sort of melt up trades in China a number of times over the last 15 years. And you know where they always end up back? Right where it started every time. So with round trips like A shares 50 to 100%, I think this will be the third time, and I think it's going to round trip again. They
So
don't
you don't buy the end of the involution thing? That's just
No, they don't
more
grow
narrative?
earnings. They don't grow earnings. So MSCI China earnings are like barely up on 15 years ago. The system is not designed to maximize profit. They don't really care about profit. The system is designed to enhance and protect the power of the CCP. And I actually now think that this has been a multi-decade plan to dominate global manufacturing for geopolitical means, and they've done a pretty good job.
Right.
They've done a pretty good job. So there is a narrative out there that I think's driving the performance, and I think Louis Gave is probably the biggest proponent of this, which is that China's won. Right now, if he's correct and China is the new hegemon, then maybe we look back and say this was like a multi-decade Amazon strategy. Right?
That's a good
Like,
point.
like you forgo profits for 20 years
Yeah.
and then dominate the market, and then you start making money. So, I can't totally discount that. I think the Trump administration is genuinely dedicated to preventing that. And I think they have a good plan in theory. The execution has not been great. Who didn't know this rare earth thing was going to be a problem? I don't understand how the president walked into basically he walked into a punch on the chin in Busan in November. Like, and my hunch is that stuck in Trump's craw because he got his butt kicked in that meeting because he had no cards. He had no cards, and Trump himself wrote 2 or 3 executive orders in the first term on this.
Right.
I mean, everybody's known this was a problem. They didn't think China might play it. Now, the fact that China played this card does tell you how vulnerable China is. And you know, my mantra back to the beginning of this year was strategic decoupling as Besant and Greer lay it out, which is no or limited trade in strategic sectors and balance in everything else. Okay, that's what strategic decoupling is. And Greer's okay with the balance in everything else being what I call baubles for soybeans. So he talks about managed trade. We'll buy the trinkets and you buy our beans, and then we just don't do business in you know, sensitive stuff. I don't like that. I'd rather just tariff the bejesus out of them and see what happens. But I'm a real hawk on China, and I'd just as soon see us try to knock them over.
And so, do you have a trade for us? Like, do you?
No,
think-
well, let me just finish by saying the strategic decoupling, as they've outlined it, is an existential risk to the Chinese system. How do we know that? Because they wield this rare earth weapon that's been 15 years in the making and can only be fired once out of the hangar. Right? They took the mask off. They said, this is how we're playing now, right? We have this weapon and we will use it. So now everybody knows it. Can we fix it and defang the weapon? I hope so. I think so. It's a small market. Global rare earth magnets, 20 billion. Let's just throw 100 billion at. Instead of throwing whatever 60 billion bombing Iran, maybe we should have thrown 60 billion at the rare earth magnets. But now I'm off on a rant. But I think China's behavior tells you that this strategic decoupling policy is an existential threat. They cannot allow it to happen, and they will do whatever it takes to prevent it. So this is a big story over the next 2 years. You know, we talked about options. 2-year dollar CNH calls are as cheap as they ever were in vol terms, and there's a big discount in dollar CNH. So these options are cheap. You know, because
And wait, I just want to explain for people. You're saying calls, but that's because it's an inverse currency, so they're betting on the CNH going down in value.
Dollar calls,
Yeah.
dollar calls, CNH puts. You know, we're still got a 200 basis point plus yield premium there. So over 2 years, it's a 4% discount, and the 25 delta are out of the money. Dollar calls are the lowest vols we've seen since they started the CNH market in like 2011. So these are very, very cheap. And I don't know what's in Donald Trump's mind. I don't think the people around him really know where he wants this to go. But I think there's a pretty good case to be made that he's been barking about China for 20 years. He took it with a smile in November, but Xi Jinping really stuck it to him. And if you were really following it, it sort of made him look like a jackass. I think Trump is not happy with it. And if they can see enough light at the end of the tunnel in this rare earth thing, I think they'll go at China again. And that is going to be, you know, really problematic for markets if that happens. It's a 2027 story, probably. So maybe a little early to be buying 2-year calls, but you know, whatever. You do a couple basis points a month. I don't think you're going to regret it.
Don't make the same mistake you did in AIG.
Exactly.
All right, so we're getting towards the end here. Before I go, I'm going to ask you what, you know, like we've covered some various topics, but obviously I've directed us and asked specific questions. What do you think I might have missed? Like, what is, if you were asking yourself, what would you be at this point asking that might be missed?
Oh boy, good question.
What are you talking about with clients that we haven't brought up? What are what's on their mind? That's
the dollar's been a big story for the last year or so. So it would be the sell US trade, I guess. Which I'm not enamored with, simply because I'm not as upset by some of the stuff Trump does as some others are, particularly my European clients. Oh my gosh.
I don't think your Canadian ones are too happy either. But anyways, go on.
They're not. But I think all the people who get really wound up by Trump, both here and abroad, underestimate the institutional robustness of the United States.
Okay.
So,
And
he'll
so
come
you
and
think
go.
this whole end of American exceptionalism is overplayed, and and the US dollar that's been for sale for the last little while is actually a buying opportunity over the longer term?
Yes, yes. I think the dollars, where are we? 114.15 on euro right now. So
Yeah.
we're still seeing a safe haven bid um, into the dollar. So that hasn't gone away. Any notion that China is going to be a competitive reserve currency is complete fantasy. And I just think the whole sell U.S. thing, that the structural trade that a lot of people are excited about, is not going to play out. It's been also in a range. I mean, all my FX folks I talk to are pulling their hair out because prior to the last 10 days, it's just been a chop fest. And my base case is that continues, but this structural sell dollar narrative, I think, is a fade.
Okay, got it. All right. Before we let you go, we're going to do our fun end of the session question. And we're going to do there's something on BBC called the Celebrity Desert Island. And celebrities have to pick 10 albums and explain why they would like those 10 albums if they were stuck on a desert island. We're going to do Trader Edition. We're going to do 3 albums or bands. You can do either one. And then we're going to talk about one trader that you would bring with you on that island. So let's start with the 3 albums or bands. What are they?
Well, I'm a big Deadhead, so that's where I got to go. If you really were going to drop me on a desert island, I'd go through the catalog and pick a live Dead show and a live Garcia.
Okay, well, let's do bands then. So so we're gonna do the
Yeah.
Deadhead. So first of all, are you like following in the old days, following them around kind of Deadhead?
No, not, I would travel on occasion, but
Yeah.
if they did 6 nights in Madison Square Garden, I'd go to 4 type of thing.
Okay. And are you also what do you think of the new one or before what's his face passed away? I can't remember.
Yeah, it was great. Dead and Company.
Yeah, and does John Mayer live up to it? Like,
He was
did you
great.
enjoy that?
He was fantastic. It was like different. He definitely had added a different flavor. But until he joined that band, I really had no idea he was that
As talented
good a
as he
guitarist.
was.
It was really spectacular. I thought he was fantastic, and they were great.
Okay, so we got the Dead as number 1. What's your number 2?
Yeah, well, honestly, I'd do a Dead album and a Jerry Garcia band album because, he
Come on, I
did.
got to get one more out of you. Okay, fine. So you're doing it, Jerry Garcia.
Jerry was a lot of covers.
Yeah.
So that sort of brings in a lot of other music. You get a lot of Dylan there, a lot
Okay.
of older stuff. And
Yeah, now that you off, Ryan, you got to give me a
style.
third then.
Yeah.
A third.
And then everybody go Eat a Peach, Allman Brothers, simply because I had a run in the 90s. They used to play 6 to 9 nights at the Beacon Theater every
Yeah.
March. And that was also like multiple shows for back in the 90s. So that was sort of and again, as I said, the Wall Street was a lot more fun back then than it was now. So
I thought
that
you
brings
for
back memories.
I thought for sure you were going to say Fish. You never got into the Fish?
I've been to a bunch of Fish shows, but just not enough to like really know the music.
Yeah.
But great stuff.
I listen. I tried. I thought that I would like it, and I went, and I was like, I just don't get it. I do not understand it. It's a bunch of middle-aged dads sitting around in Elaine Venice dancing. That's how I figured it. All right. Okay, you got to tell me the trader that you take on the desert island. Any trader from any point, like in life, you could pick Jesse Livermore, whoever. Who would you choose?
Oh boy, who would I choose? I guess I'd say Julian Robertson.
Oh, yeah.
Just because I got to know him a bit, having worked for the Tiger Cub, and just a gentleman, and so much experience and all kinds of stories that he was always kind to share. So
What impressed you the most about his thinking?
just that he was as even keeled as you could imagine.
Oh, okay.
Yeah. Yeah.
So no matter what, it was one of those guys that could be getting crushed and you wouldn't know it.
Even keeled and unbelievably open minded. And to be honest with you, he always listened more than like he was absorbing your view and taking it and doing his thing. He didn't feel the need to sort of say, "Well, I think this or I think that."
Right.
He was just really interested in what everybody else had to say and absorbed it in just a really incredibly even keeled manner, and obviously synthesized it to great effect.
Well, that's awesome. That's a great story. All right, before we let you go, you got to tell us about Macro Lens. Explain what it is, who could be interested, where they can, reach out for you. You also have a Substack. Make sure you mention that.
Yep.
Give us the
So
whole spiel.
yeah, MacroLens at Substack. I post the occasional sort of sample of my institutional research, and lately I've been taking to posting some 3 to 5 minute videos on
Yeah, I like them. I see. I
on
knew you were in
Substack.
Cape Cod because
Yeah, yeah, yeah. It's tough with the social media to sort of maintain traction. It takes a lot of effort, and you get a couple more followers, and but I'm trying to. I'm committed to sticking with this one.
Okay, well, listen, everyone, go on to Substack and
Yeah.
follow Brian and get his updates so that he
Yep.
doesn't feel like he's just talking into the wind when he's giving you these great insights about the markets. Okay, and then that's
Thanks,
on your
Ben.
Substack.
Yeah,
And
and then macrolens.com if anybody wants to check out the institutional product.
Yeah.
I write a fairly lengthy note every Friday and do a Saturday video version, which some people prefer. And then, of course, when events are hot, I'll write. I wrote 3 pieces in the last 10 days on Iran and things like that. And for institutional clients on Bloomberg, I provide a real time service, analyzing the news, trade ideas, and just chatting back and forth with investment professionals.
that's awesome. Well, thank you very much for your time, Brian. I really appreciate it. It was great getting to know you.
Yeah, I appreciate the invite. Thanks for having me.
All right, Patrick, talking charts. What do you got, buddy?
Well, Kev, where do we even begin? Like the last episode we did right before the shitstorm.
Yeah.
So
sure.
this is our first episode, and boy, has a lot happened in the last 2 weeks, right?
For sure. But I would say the biggest news is that you and I agreed on something and it actually happened.
That's very rare.
Yes.
Very rare.
The
Almost
Cosby,
never.
I think we both called it correctly and we agreed. It was probably because neither one of us had any serious positions on it, unless you did.
I had some skin in the game.
Oh, you did. So that's why,
yeah.
because I didn't. So therefore, that's why it worked.
Absolutely. But let's not waste any time and dive into it. Like, first of all, let's just talk high level on the S&P. It looks like shit. Like we can move on now. It's we're negative on the day. We were temporarily positive, but the same pattern is there. We have technically now entered not only gamma flip territory, but we've entered where systematic traders are deleveraging at a time where clearly the trend is not your friend. All sorts of stresses are coming in the markets. The market is clearly in some form of a distribution. And while there are some people that are eager to call the low because we had a VIX blowout to 35, I'm not so sold on that. I think that the VIX, certainly look, sentiment has turned. Whether you look at the CNN bull bear, fear of greed index or whatever it was, or the AAII thing, they're starting to get bearish. I mean, things are getting negative, but I really think this sell cycle in the manner that it's going needs an actual price capitulation, not just a indicator capitulation. I think that the vulnerability at this point is to downside. The thing is, we're recording this. By the way, notice it's at 666 right now on the index while we're recording. So it's like it's meant to be at this moment where we're at a critical moment on the markets. But bottom line is this: there's no reason for the market to stop here on the short term. Now, I do not. First of all, what do I not want to call here? I don't necessarily want to call another Liberation Day crash. I don't want to call a COVID crash. Like, I'm not in the opinion whereas of this moment, that this is going to be a devastating drop. But for us to have a 10 to 15% market drop here is to me would be normal considering the magnitude of rise. Like, put in context, off of the Liberation Day lows, we had a 45% rally in the stock market. For it to step back 10, 15% on a retracement to give some things back is very normal. And so this can go deeper, it can go farther and if I was to give a path, I wouldn't. And actually, this is what I wanted to talk to you about. On the short term, I think we go lower. And lower could mean even 6,000, even temporarily below 6,000 on the downside. No guarantees, but would not shock me if we saw this. But the question is, does this play out a little bit like the analog of 2007, where when Bear Stearns stuff started happening in the summer of 2007, the market dropped about 15% and then managed to rally all the way back to its highs and before rolling over later. And what I'm trying to figure out here, Kev, is not that I'm, by the way, calling for a great financial crisis, but even if we do get down to 6,000, does it still have the buy on dip reaction where once we get to a capitulation point and everyone is trained to see these very extreme oversold levels, do we see a reflexive rally off of that shocks everyone to the upside of the fact that it can completely reverse the entire sell-off? And so I wanted to kind of get your opinion on that. First of all, do you think that that kind of a downside target is reasonable? And do you think that the market is even capable of doing something like what I described?
Going down to 6,000? For sure.
And then shocking everyone with a rally back to the highs.
Oh, for sure. First of all, good trader never says never. So anything's possible. But before we talk about that, Patrick, I want to just point out the fact that you mentioned the 2007 scenario. And ironically enough, I was just informed that Jim Cramer tweeted an hour ago. Do you know what he tweeted?
No.
Quote, not buying the 2007 scenario, unquote. So what does that mean, baby?
It means that, first of all, enough people are talking about it.
Well, no, it means 2007's back on the dinner plate.
Of course
buddy.
it is. You got to fade Cramer. Like, this is a given. Like, this is.
Did you see how bad he was when he literally said something was like, oh, the war is no big deal and blah, blah, blah. And then literally the next day it took off and got all worse. And then at the absolute highs on oil that Sunday night or Monday morning, he came out and said, there's no way this doesn't escalate further. His timing was absolutely terrible. Like, he should just hang it up because it's an embarrassment. He's just flailing around.
Yeah, it's hilarious because it's almost like, like at some point people learn from their mistakes. They say, hey, what I'm doing isn't working. Let me change my playbook a little bit. But like the consistency, like he literally just comes on and literally does not change his playbook at all. He just basically says, it doesn't matter if it didn't work. I'm still of this opinion. And my opinion
he goes, even George Costanza figured out that he should go the other way.
Yeah.
And so that's the problem.
And that's important, right? Like you have to be able to know when you hang up the thing and say, like, it's not working. I got to try something new, right?
I'm a middle-aged balding man living with my parents. You want to go for a date? All right. Back to the stock market. I think that 10% is easy. I completely agree with you. To me, you're already talking about a bounce back that surprises everyone. I think everyone's looking to buy the bounce. I'm more scared about something that accelerates to the downside. And I'm not calling for this. I'm not saying that that's what's going to happen, but just the fact that everyone is more interested in the bounce than the actual fear of something more significant happening, it says a lot to me.
Okay, so this is a great segue to kind of talking about the risks. Now, first of all, a lot of people are hinging off of Trump's tweets, and particularly, are we going to get a Trump taco here? In a, like, is there going to be a cave? And it's like the reaction that happened the other day, earlier in the week, off of a Trump tweet. It was almost like Trump is going to dictate this. But for me, obviously, and I want to highlight, like, obviously we know that high oil prices and this kind of a move in oil is going to have some intermarket effect on equities and on global confidence and all sorts of other implications. But in my mind, this stock market deterioration and correction was setting up and actually starting without the war anyway. You had the Mag 7 weakness, you had the rotation underway, you have the private equity and credit crisis really getting underway. You had the AI innovation causing all of the stress points in the software stocks and all these things. These things were happening even if oil didn't go up and if the confrontation didn't start. So if those are really the underlying reasons why the market is deteriorating, then why would anyone hinge on the idea that Trump will taco out of this war and somehow all those problems will go away?
Because they don't think those are problems, Patrick.
Right.
They think that the economy's great, everything's terrific. All us panicking, quote unquote, are worried about nothing. The economy is doing terrific. And listen, there are some signs, like you can make a bullish argument. Earnings keep going up. The reality is tax receipts are coming in higher. My buddy Vincent Deloard, he keeps harping on that. He keeps saying, look at this. It's tough to say the economy is doing bad when the actual cash that the economy is generating is increasing. There's all sorts of positive things that people are focused on. I happen to think they're kind of glossing over the negative things. The fact that employment sucks, that as you say, there's some problems in private credit. We have a situation where the dollar is going up right recently, but on the long run, I think that there's a huge current account deficit that needs to keep getting funded. There's a million things to worry about. And the one thing that really struck me was funny, Patrick, was that I was chatting with someone the other day, and he told me that recessions just don't happen anymore. This is a fellow, very, sophisticated investor. And he's just telling me recessions don't happen. And all I could think about was all those people who told me in late 2010s, inflation is a thing of the past.
Or those people just 3-4 years ago that said gold miners were doomed and never going to rally.
Right.
Because what they're doing is they're looking at the past and what has happened as opposed to what potentially can happen in the future. Right.
Yeah. So I'm with you that right now people are blaming the stock market, correction, although it's not much of a correction, Patrick. Like, yes, it's looking weak, but if I told you that U.S. and Israel were going to strike Iran and it was going to result in the Strait of Hormuz, and asked you to say how much the stock market, the Strait of Hormuz being closed, and asked you how much the stock market would be down, I don't know about you, but I certainly wouldn't pick 5% or whatever we're down.
Yep.
I would have said 15, 20. And one of the things that I find kind of the most...
Well, 15, 20 is kind of crazy. I would not have said 15,
the Strait of Hormuz being closed? Is that big deal?
I wouldn't have said 15, 20. I'm just telling you, I wouldn't have.
I would have said 10 minimum.
Look, oil prices going higher are a factor. But I mean, in the end, how do it does influence consumer spending and other things. But for the stock market to wipe out 15 to 20%, like a huge repricing and pulling multiples out because they're cleaning up a regime in Iran, doesn't seem like I wouldn't draw that conclusion. If you would, that's your thing. But like I would have never anticipated a 20% drop.
With I would
Well,
have thought,
but I
I'm
do
not
think
20.
we
I'm
can
not
get a
putting 20,
20%
but I'm
drop.
saying 10 minimum was what I would have said.
Okay.
10, like with
We're
oil
down
going
7.
up. Well, okay, and that's
Peak to
finally
trough.
now, but it's been a hard 7 to get, and everyone's been trying to buy every single dip,
Yeah.
right? And that's the part that I find amazing, right? Every single strategist is out there talking about that chart that Marco Papic made, which shows how stocks rally after geopolitical events. And we usually get a dip on a geopolitical event. We didn't even get a dip because people are so busy buying it in anticipation of the future stock market rally
No.
2 months to
But
3 months from now.
but let me pose something to you.
Yeah.
Okay. I would have believed that Iran, and while they probably didn't know exactly when an attack would occur, but I do have to believe that Iran wasn't naive enough to believe that this wouldn't inevitably happen, that there would be an attack on them. And what you can also, I would assume, is that Iran would know that they literally can't militarily beat the United States with their technology and weapons and everything else. And so, if you can't beat the United States at a kinetic war, how does one actually hurt America? And if you can't beat them, on a militarily basis, you have to target the one battlefield that matters to the U.S., and that is its economy and the markets. And the fact is that if Iran knows that they can't beat the U.S. on a hot war, then why wouldn't they try to defeat the U.S. by basically causing so much economic damage that the U.S. has to back out because they simply can't deal with the consequences of it? Like, what do you think of this idea?
Well, of course, I completely agree. And I always
And
said
so,
when people were telling me that the U.S. was going to crush Iran, I was like, of course they're going to crush Iran. Nobody in the world can stand up to the U.S. Nobody. The U.S. is the largest military out there by a factor of 5 or 10. Nobody can stand up to them when it comes to fighting a regular war. But the reality is that, U.S. on paper should have crushed Vietnam as well. And Vietnamese found ways to fight in ways that were unconventional. They went off into the jungle and then hit and then kind of went back. Same with Iraq and Afghanistan. And it's just, I think too many people are focused on an old fashioned type of war and not thinking about what it's going to really look like. And to your point, I think that striking economically is what they're going to be focused on. And that's what we've seen so far. Yet the stock market thinks that there's no problem. And
more
yes,
importantly,
okay, it's
Trump
finally
tweeting,
down
"Hey,
now
listen,
7%.
Trump saying, "Oh, we've achieved our objectives." This, the lights at the end of the tunnel, kind of shit. Reality is that if they want to keep the strait open, Iran may at this point um, continue to be an absolute nuisance, causing insurance rates to go through the
Yeah.
roof.
It's even
Continuing
if the U.S. declares all one, everything won and everything great, it doesn't mean the strait opens. Anyway, so let's not talk too much about the geopolitics because
the
everyone's
point I'm
talking about
making
about
the
geopolitics.
point I'm
What
making is that the stock market is not pricing in how prolonged this entire thing can be, and
I
everyone is
completely agree. And
offering this shit with
I
this.
love your earlier point, Patrick, that I just want to take us back to, which was regardless of the war, things were already rolling over.
Mhm.
And I think that's what we should focus on. That's what you and
Let's
I are
let's
different
do it.
in our analysis versus most of the rest of the street. Because everyone's either talking about the war and arguing about that and then saying once it's over, everything's going to be great. And we're saying, listen, regardless of the war, it's not good. But the fact is that the economy was already headed this way. And I am in complete agreement with you that that is the reality of the situation, and that it was rolling over. And if anything, this just accelerates the things. And even if tomorrow somehow Iran just says we give up and everything's great, I don't think that means a rally and everything's terrific and we just head off to new bull market.
I'm with you on this.
It doesn't solve the private credit stuff. That's huge. It's monstrous. There's the uncertainty from the midterms. There's the problems in terms of the fiscal stimulus is now more difficult to do.
The AI innovation, displacement.
There's just and this is all coming at a point when the stock market in the U.S. is very expensive, very rich compared to previous valuations. It's the risk reward is just terrible on the long side.
So let's go through the charts.
Okay.
Number one chart. There was something very important broke in the last week. And that is, we were even last week and many weeks before talking about the sector rotation story. The idea that money was leaving the Mag 7s and it was chasing the other sectors. We saw strength in a lot of everything from resources, energy stocks to consumer staple names, utilities, whatever. There was a whole array of sectors hugely benefiting from that sector rotation, and that caused the equal weight index to be doing very well. Last week, something changed. What you can see here is that this is the breadth indicator of using the number of stocks above their 50-day moving average in the S&P 500. And it basically, we were nicely in a bullish way a couple of weeks ago, sitting at 65, 70%, where 2 out of 3 stocks were rallying, showing that the breadth was healthy and fine, to basically collapsing to 31% in a week. We're now seeing that the sector rotation breadth story is dead. We're seeing that more and more stocks have joined the downside party. And that was most evident in the breakdown of the equal weight index, which basically we saw a beautiful bull market happening in the equal weighting, is that the Mag 7s weren't just influencing the index anymore. And there was a huge run. And the last 5-6 days, we saw a legitimate breakdown of the equal weight index. And so what we're seeing is that we've moved away from a clean sector rotation out of Mag 7s and into everything else, to now the selling has broadened.
Right. That's one of my subscribers asked me. He said, "Is the immaculate rotation over?" And I said to him, I said, "You have to. That has to be on the table. That has to be a possibility that you have." It
has to be a possibility.
Yeah.
And so, a lot at the same time, you have a scenario. Okay, well, here's the software stocks. Yeah, everyone was getting excited about this bounce, and it was a $10 bounce. On anyone could, on a percentage basis, say, look, it bounced 15% in 2 weeks. Like that, the bottom is in. But you have to always look at reflexivity in terms of the magnitude of the bounces are always have some sort of symmetry to the magnitude of the prior drop. And so when you have the software index basically in like 2 months wipe out 31% to the downside, expecting a reactionary bounce from like a dead cat bounce from an oversold condition is just textbook. It happens almost every time. And the bottom line is this is still a prevailing downtrend. And this bounce failed below its 50-day moving average, below all the fib zones. There is literally no evidence that this is a change in trend, but rather simply an incredibly oversold condition that needed some sort of a relief bounce for profit taking and short covering, and draw some short-term value buyers that want to try to scoop up lows. By no means can you call this a positive chart. Now you take that Mag 7s then, and they are literally at the edge of a cliff. You have them bouncing. Think of it like a ball bouncing at towards the edge of a table. Each bounce being weaker and weaker each time it tries to rally. Not even a test of its 50-day moving average once during this entire sequence. Like if this breaks this support line, the Mag 7s are heading lower, bud. Like to me, it's very hard to find anything structurally positive on that. You're smiling. So go ahead and
No,
make your post.
smiling because you talked about that support line, and someone, or maybe I was going through my old pieces or something, and I found this meme, and it's this young schoolgirl, and she's sitting and she's drawing with crayons, and she's sad and she's crying, and she's like all bundled up with like anxiety and sadness. And it says the horizontal line didn't work. Now my calls are worthless. And I can't help but think about you. I'm sorry. It's just the one she mentioned, the horizontal line.
The horizontal line didn't work.
Now my calls are worthless.
But forget that. Just study the price action. The price action is outright distributive on the Mag 7s. There's no pulse. And let's talk about the market call that we together were talking about last week, or 2 weeks ago, which was the inevitable Kospi top. And while the NASDAQ hasn't legitimately broke down with it, the one thing we were right about was the time frame, from which is the fact I said between now and this episode, there was going to be the swing high or intermediate high put in the Kospi. And so we have the swing high on the Kospi, and the bounce is been off of the 50-day was relatively weak. I mean, we have a scenario where almost all global equities are now in sell mode. You've got the Nikkei dropping below its 50-day moving average. On that, you have a legitimate ass kicking on the Euro stock here. Let me just pull it up here. Like a complete and solid. What is it a percentage wise? Let's see. That was like a 10% drop in the Euro stock from peak to trough. You have India, which is clearly the one of the countries most impacted by the strait being shut down, is like, what was the number? Like 85% of all oil that they import comes from the strait.
Yeah.
So India did not take this well. All right. Like this is an absolute shellacking on this. And then you have to then go like 13% on the Sensex. But then you have to recognize that the emerging markets hate a rising US dollar. We'll talk about the dollar chart here in just a moment, but emerging markets taking a legit reversal. The bottom line is the entire global equity complex is getting hit. And this is not just a U.S. thing anymore. And so the selling really broadened. And you can't ignore that this is no longer just a sector rotation story. But now selling has legitimately widened broadly. And this is why, like, the only thing that I keep hearing of from the bulls is that, but the VIX hit 35, so the low's got to be in, right? Yeah. And, yes, there is a strong correlation. There's no denying that a lot of times when a key market bottom occurs, it is associated with a spike higher in implied volatilities. And often you can use it as a fear index of when everyone's grabbing at the put protection, it usually is a capitulation moment. But I've learned that you want to see not only a spike in the VIX, but actually a price move that in some way reflects the magnitude of the VIX rise. I mean, if you have a spike in the VIX and the stock market's doing nothing, then to me, that spike in the VIX doesn't have the same value. It doesn't have the same weighting to it. And I feel like those people that are anchoring too much off of this VIX spike, well, go back to previous bear markets, and a prolonged elevated volatility spike can stay up there for many months and just work its way higher as the situation deteriorates. Just because we've printed up here is not like somehow guaranteeing that there's going to be a low.
I couldn't agree with you more. I suspected that spike in the VIX is actually a function of the dispersion trade, and that there was really just some technical covering of index vol that caused it to be bid. But in reality, it wasn't a function of real clients buying VIX or buying S&P put protection. I'm sure there was some, but it didn't feel panicky at all. And in fact,
it didn't.
it just everyone was going the other way. So I suspect that was more to do with than professionals trading amongst themselves.
Okay, but we are legitimately 2 weeks of staying above 20, right? So this is an elevated volatility premium. Yeah, we can talk about whether 35 was real or not on the upside, but overall, we have a structural rise in volatility. And it's accompanied by, even though we have not had some really crazy days, like 200, 300, 400 point days, overall, realized volatility is on the rise. And this is obviously everything.
Okay, I got to push back a little there.
Okay.
Yes, it's on the rise, but it's still shockingly low.
Shocking. No. It's not at crazy levels. We haven't seen big moves yet.
Right. And the volatility risk premium, which is the difference between the implied and the realized, like the forward looking implied and the backward looking realized, is hit one of the highest levels we've ever seen, I think. So I don't know. There's something strange happening there. And I'm just trying to pull it up here and see what the 1 month realized was. What do you have it handy? The realized?
I'd have to look. No, I don't actually.
No, okay, let me just look here. Vol, and we'll do 20-day, or should we do 10-day? Let's see. Okay, I got vol for 10 days. Vol for 10 days, it's still 13. Like, considering that, S&P's ticking at 35. Or even now, like, what is it now? 30? What's the number? I can't see it.
Right now, the VIX is at 26.
26. So think about that. There's still 13 vols of volatility risk premium there. It's still really high. And that has to do, Patrick, with the fact that we had this huge rotations for the longest time. For the first, 4 days of the war, I think that the stock market was unchanged.
Yeah.
Like, I had a chart that I showed the first 4 days. They did it on the weekend. We gapped down. We closed unchanged on that day. The next day it went kind of bad. We gapped down, and then it closed off the lows on the highs. And then by Thursday, it was unchanged on the week.
Yeah.
Anyways, you got a lot of charts to do, so I should stop talking. Keep going, bud.
No. Listen, okay. These are good conversations. Like, we don't have to think, but overall, I feel like the key takeaway is that just because we're at elevated vol levels, everyone should just calm down in rushing to conclude that it's a low of the market cycle. Okay. The fact is that the price action remains distinctly distributive in its nature. So what I wanted to do is talk specifically sectors, right? So first of all, let's start with the SMH and the semiconductors. So the noble animal appeared in the semiconductor space.
Oh, it's perfect.
Like the prairie dog pop happened on the semiconductors. The irony was that traders felt compelled to clear that high the day before Nvidia earnings. Like somehow, they knew the outcome of what was going to happen. And Nvidia legitimately was the catalyst for the prairie dog.
Which is even better when you have a prairie dog on a news event.
Yeah, absolutely.
Like chef's kiss.
So let me take a nice and thick crayon and let's hope my calls don't expire on the support of this this thick horizontal crayon line. But what you have is the highs from October and November on here, with the lows of basically February and March that were established, that basically make this kind of, let's round it to $380 for the sake of having a round number. But this has been more or less a support resistance line. And if this is some form of a double top or some mutated version of some head and shoulders pattern, let every technician put whatever geometric shape they want to jam on this thing. Bottom line is, if this is a topping formation developing, if the semiconductors break down below this level, then that is an end of its trend. And it's been bull trending all the way since the Liberation Day lows. And so this would be the first reversal point of this. And that's coming with the Kospi top along the high. And what's interesting is Nvidia is very much putting in some sort of I'm sure definitely technicians want to see the head and shoulders pattern topping through Nvidia, making its crayon line here particularly important. Like if Nvidia somehow here starts breaking down these lows, it again signifies that it's in a new sell cycle, and that really could only exacerbate the situation even further. But what I continue to think is one of the most important things is looking at these financials. The XLF financial index has been selling since the start of the year. We have had deterioration in the major bank stocks very clearly. We're down 14% basically on there. And this is your quintessential beta 1 asset to the index, right? The banks tend to just move with the indices. And so the fact that we're down 14% on the banks tells you a lot. And this is where obviously private credit stresses and the potential of tight liquidity conditions is most evident. And obviously the private equity things, obviously everyone's listening to all these stuff on this private equity credit, but like take a look at some of these like Blackstone, basically below Liberation Day lows, right? You take Owl, the blue owl, it's its Liberation Day lows were at like 15-16 bucks. It's down to $9-8, like 8 handle.
Yeah.
Like we're talking about a private equity breakdown, but now funds that had private equity like BlackRock had a monster gap down here at the start of the week, clearing October lows, very clearly defining that they are now in some sort of sell cycle distribution. And so not only do we have the tech stocks and Mag 7s weak, the financials are rotten. And the breadth of the market has actually deteriorated. So all of those other sectors that were carrying all the weight have stopped.
Right. I'm with
so
you,
is
bud.
this a market that you want to buy? Like
Well,
I'm at this moment, look, everything is a buy on dip. I don't want to say that, everything's going to zero. At some point, every asset becomes cheap enough that there's going to be a key bottom and there's going to be an extraordinary rally. We've been doing this show through the COVID lows and through the Liberation Day lows and the 2022 bear market. When things are oversold enough and start a bull market, we call it the way it is. This just seems too early. It seems like we're in the middle innings of something, not the late innings of something.
oh,
And
Patrick, I couldn't agree more.
there's something that's still developing. The cockroaches are still just emerging here.
Yeah, and the Walter Deemer line that I love the most is like, when it's time to buy, you won't want to, and conversely, when it's time to sell, you won't want to do that either. Yeah. And the reality is that everyone wants to buy. Nobody wants to sell, and this is the time. We've been saying this for a while, though. My problem is that you have to be careful. Yeah, okay. So to your point, it's finally agreeing with you, and I will say that I actually want to cover a little bit of my shorts. So this is the biggest sign that things are about to get really sketchy on the downside, because I'm thinking about bringing some in.
No, but listen, let's kind of call it the way it is. So for instance, BlackRock and the financials generally were strong in into the first month of the fourth quarter, and they got heavy. The stock market basically did not make any further highs legitimately from its late October high, right? So what we're seeing is a scenario where we were acknowledging that things got overstretched on the upside, but topping formations are prolonged distribution cycles often. Rarely do we see V tops, like where it just pops and drops, unless it's a bubble like the Kospi. And more often not, the stock market bumps its head, stays stuck in long trade ranges. And just because we were talking about the very poor asymmetry many months ago didn't make it less true. It's just the thing is that the stock market ultimately needed to exhaust all the buying pressure and ultimately give a catalyst for the sellers to overwhelm the bid. And we're now finally seeing some catalysts that finally emerged that is driving some form of profit taking cycle.
Got it. Okay, so let's go through the charts. So let's talk U.S. dollar.
Thank you. Because what is the most important thing to talk about this week?
It's always the U.S. dollar. It used to be always the U.S. dollar.
No, but this is actually for real, buddy.
Listen, I just want to say, I think it was a week ago. I noticed all of a sudden on the days when the geopolitical really, heated up and there was a really bad headline or two. And I think there was one day, maybe it wasn't this past Wednesday, but 2 Wednesdays ago, where everything went down and the only thing that went up was the US dollar. Like gold got hit. I guess oil went up, but gold got hit. Stocks got hit. Bonds got hit. There was this period where everything was selling off except the US dollar. And that was the point I said, oh, for the first time in a long time, the US dollar is actually behaving like a safe haven asset. Yeah. And you'd be proud of me, Patrick. I gave up trading from the short side and I said, I'm going to get a chance to sell this higher. So far, so good. I'm kind of neutral-ish. I do own some yen, but that's a different kind of trade and with long-term options. But I'm hoping we get a pop above this line you've just shown. And that at that point, I want to lean into it because I think that there's a chance of a prairie dog here.
So I'm not going to disagree with the long-term view that you have because I think that there's a rationale behind it. So technically, this is the way I kind of sized this up. That was to the opposite of the noble animal. This was a little turtle head poking out when we broke down in January.
That's true. Actually, it is. You're right.
And it was the fake out breakdown that happened, which basically once we got above the 50-day moving average at the first days of March, solidified that there was not a downtrend, but rather that the prevailing trade range that was established since the summer of last year was the dominant trend, which is it was range bound sideways and chewed up in a consolidation pattern. And that breakdown was just a fake out on the downside, and that the trade ranges were dominating. Now, what we're seeing now is the safe haven thing in its most traditional form historically. And there are arguments to be made that there are going to be periods in the future where this may not work. But using historically the historical intermarket relationship that has been is that when there are crises, it's the scarcity of dollars that everyone turns to as a safe haven asset. And we are clearly seeing things unraveling. And to me, I don't like it when the stock market just gives me a sell signal. I like it when it's confirmed by a whole bunch of things. Breakdown in junk bonds, breakdown in credit, breakdown or a rally in the US dollar, other stress points developing in other areas. What you want to see is that it isn't just some technical candle that is giving you a reason to sell, but something is happening on a broader basis that in fact is showing that there's a regime change of some sort happening in the market. And to me, this US dollar, I was first under the hypothesis that this trade range will prevail. But here, if this dollar breakout sticks, I don't necessarily think we're going back to 110 or something like this, but a Fibonacci retrace of the sell-off, which is something that has happened many occasions in the past, is a rally to 103, 104. Yeah, so I don't know whether this is a prairie dog here, Kev, but especially if this is a prolonged sell cycle of some sort that doesn't last, the dollar could easily go 3-4% higher from here in a period. Overall, once everything settles, it probably will resume its downside bear trend. But I'm just not thinking it's as soon as you like a quick prairie dog here fake out. I think that this dollar breakout, if it sticks, we could easily have another 2-3 handles, even 4 handles on the
Oh,
upside.
I think it's going to go fast. I think it's going to go in a whoosh. So I guess that's where I'm agreeing with you that the breakout will get everyone excited. It will cause a very accelerated rally in the dollar, and at that point, I think that the Fed will have no choice but to go and actually ease and be the easiest central bank on the other side. So
Right.
it's in anticipation. And I'm not saying I do it on the first day or whatever. I'm saying a week into it when everyone's all bulled up because the thing's gone from 100 par 50 to like 102 or something like that. It's just a big whoosh. And everyone's all bulled up on the dollar. That's the point where I want to start looking at it. Because I do think that if we get a situation where there is an event in the financial markets, the Fed will have no choice but to go and to ease.
Right. And so, what a great little segue into talking about the rates markets and pull out our stir trader charts. But I wanted to highlight that both on the 2026 December and 2027 December contracts, the SOFR futures ate it. And let me share my view because it's very different. I mean, we had Jim Bianco come on to Macro Voices, that show I cheat on you with, and basically, they're talking about the bond market needing some sort of protection from the inflation fears. But as far as I'm concerned, a war premium on oil is about that's the greatest definition of supply shock inflation that is transitory. Like, to me, we could go to $120 to $150 a barrel and be back down at 76 months from now. And the idea that this requires monetary intervention in order to manage this transitory inflation shock is, I think, completely unnecessary. And I think if the Fed does in any way respond to it, it's going to be policy error. I think that overall, the Fed can't turn hawkish, and therefore, if the only end result is dovishness on here, then this is an extraordinary buying opportunity.
I'm with you, Patrick, but I think that what you failed to talk about there, which I think is really important, is the fact that we had a situation where it's moving with oil. And I was just in the process right now. I do this private feed recap, and I had a great chart that I included. And Patrick, if you just go to the post.themacrotourist.com, and you'll see that the M Tourist private feed recap, I've made it open for everyone so everyone can go look at this chart. And it's the chart of the December 2026 SOFR future versus the 12-month WTI contract. And you'll see that it's almost following it tick for tick. And so what does that mean? That means that basically, as the stock market, as the crude oil market has rallied, and as this inflation is starting to get embedded into the economy, the market is assuming that the Fed will not be able to loosen as much as they previously were going to do. So they have been taking out
rate cuts.
Right. And so I think that's a super interesting kind of development, because what that's telling you, one, is that this idea that Kevin Warsh is going to come in and be able to just dictate where policies are, and that he's going to be, Trump's bidding. The market is calling bullshit on that. The market is saying no. The FOMC as an institution will hold, and the Fed's reaction function will stay the same. So I think that that's super interesting. I also think it's interesting that as we get this rally in oil, I think it puts more stress on the economy. And yes, I understand from an economic or a macro environment, the U.S. doesn't import oil, and so therefore it ends up being a wash because they're roughly neutral, or maybe they're a slight exporter. But the reality is that it's taking away from the consumer and giving to oil companies. So it is going to slow the economy. There's just no doubt about it. So what I suspect will happen is that this will cause increased pressure on the economy, will slow the economy, and then we will eventually get a situation where the Fed is forced to lower rates because the economy is rolled over. And ironically, Patrick, one of the things that I just wanted to highlight.
Hallelujah. That's
well, listen, I got something else to say that's going to blow your mind, buddy.
all right.
Okay, but we'll get there when we talk about bonds. But when it comes to back to this idea about oil and the economy and it's slowing, I thought it was ironic because over the years I've heard, oh, oil is always the thing that is the final asset to rally, that causes the economy to roll over and causes the stock market rally to come to an end. And I said to myself, and I was laughing the other day with some buddies, I was saying, here we are, the oil market is spiking higher. And this is the point everyone told us that, that this is what causes the economy to roll over and causes the end of the stock market. And everyone's still bullish stock market. Right?
Absolutely.
Okay. So anyways, going back to this thing, one of the ideas is that I wrote a piece recently about the economy being weaker than everyone expects, and for a variety of different reasons. And we kind of going over some of them. And I had one of my buddies, super, super smart guy. And he reached out to me. We started chatting and he started asking me about how to play this. And he says, I'm sympathetic to this. And I said, well, you got to buy the front end because eventually the Fed's going to cut rates. And we're going to have this environment where the front end goes straight down. And he says, I hear you, but I feel like you should own the bond market. And I said, no, like you got to be worried about term premium and all these things. And I gave him all these reasons. And he says, yeah, I hear you. I understand all those reasons, but the bond market is the most contrary market in the world. And the reality is that nobody is long the long end. And I realized he was right. Like, tell me somebody that's out there saying you should own the long end. That isn't always
David
long.
Rosenberg. I don't know.
Yeah, but he's always long the long end. Like somebody that's actually willing to not be long the long end. There's nobody.
Lacey.
But he's always long the long end. And I was thinking,
hold on, let me consult my poster in the bedroom.
And I have this line that I always say: the hardest trade, the hardest trade is often the right trade. And to me, I feel like the near universality of people saying that the long end is not a good investment almost feels to me like we might get a tradable rally in the long end. So Patrick, I am thinking about buying the long end for a flattener because
I have a tear in my eye.
I know. I can't believe myself. I haven't done it. But I'm for the first time, I'm just like, oh, I get it. And if we get a situation where, let's say the oil stays elevated and it does do what we say and it causes the economy to be slow down. And then we get a situation where the Fed feels like they can't go and lower rates. We could get it. We could get a flattening of the yield curve, something nobody's expecting because everyone's worried about runaway deficits and term premium blowing out, all the things that I used to, chat about and nobody would take seriously. And now everyone's convinced that it means that this long end will never rise in price.
What if the flattening is also a general decline in rates? Like it could be a flattening, but at lower levels.
Yeah, no, but the flattening though, if the Fed chases it down, and my point is that the stir thing about the fact that the front end of the stir of the front end of the yield curve is following the oil market is very much a sign that you can probably go and buy the long end. Now, Patrick, if I was wrong, let's say Warsh came and he convinced everybody that no, they have to push back on that and they're going to go cut rates at the front end. Like if Trump got his way, then all bets are off and I am selling the long end. But assuming the institution holds and assuming that the Fed reaction function stays the same as expected, then I think the long end, you might even want to own it. And I know that's terrible, dirty. Like I feel
You
like
should
I need
feel
to have a
dirty, but
shower. Like and stuff.
you know what? In spite, I did all my short-term tactical trades are flat on bonds at this moment.
Yeah.
But I have long core positioning in these and I don't think that there's an issue with holding these things at these prices, even though short-term volatility is guaranteed. Because imagine for one moment that something happens over the weekend and oil's at $150 a barrel. Like, is it possible? Absolutely, it's possible. And if that happened, then the bond market swooshing one more time to the downside is there. So I would say there's zero market timing benefit on the very short term. You have to expect maximum volatility here. But if you ask me where the bond market was going to be 3 or 6 months from now, much higher from here.
Yeah, lowering yield. Like I was thinking about it, I was like, oh, if I'm right about the economy, I could see a 10 at 3%, 10s at 3.
Wow.
Like I don't think that's as insane as it sounds.
No, what do you mean? We've been there before.
Well, I know, but for me,
that does sound insane. But it might set up for the next major bond short later on in 2027, 2020. But we'll talk about it another time.
And then because I think what happens is that all sets up, and then that all creates the next run into real assets that is absolutely huge, because at that point we'll have full on central banks lowering rates to zero. The confidence in financial assets will be shaken, especially with the private credit and the AI crap, and it will be just a massive decade-long run in real assets.
Yeah. So I want to talk bonds here for a moment, but not going to go to long bonds at this moment and treasuries, but I want to focus on corporate shit. Okay. And particularly, I want to start by first of all, I'm going to start it by saying, we've done it on the show, and you were the one who brought this to my attention. And you can correct me if I'm not paraphrasing you correctly, but there's been a lot of market corrections we've had that are in the 5 to 10% variety that didn't have credit issues in high yield or corporates, but almost every stock market drop of 10+% has seen stresses in corporate credit.
Correct.
Am I paraphrasing more?
I wrote a piece about that. Basically, the difference between a 10% correction and a 20% correction in the stock market is often, but you can look at it and see it in credit.
So start with investment grade. Investment grade bonds, just eating it in the last week.
Yep.
Just eating it. Take junk bonds. While the first gap down was a dividend thing, but overall, they've been eating it. Let's talk canaries in the coal mine. One canary dead. Second canary dead. Look at the third canary. Look at what senior loans have been doing for the last 3-6
Actually,
months.
Senior loans are way worse than that even. They're than the other two. Senior loans have been leading on the downside. It just doesn't look like it because
they're a reflection of the tightness of credit conditions.
Well,
right?
But also it's that their volatility is so much less. So it doesn't look as scary, but in reality it is. And that is where there's a lot of pain.
The point being here that we're seeing the credit markets under a lot of stress. That private equity credit is kind of like a contagion, tightening up conditions. And this is where I'll ask you, can the Fed surprise with an ease? Because maybe the liquidity conditions, repo markets, everything starts seizing up, and they have to come in there with some sort of balance sheet intervention to essentially provide some sort of liquidity in this kind of period. Could we see a surprise?
Yes, we could, but we need much more pain in the financial markets before that occurs.
All right,
we need to see real fear. We haven't got fear. Everyone's buying the dip.
Well, a lot can happen between now and next Wednesday when Powell's on the podium.
Well, I don't see how he's going to lower rates.
No, he's not going to lower rates unless it's an emergency.
Yeah.
But the thing is that he can't not address this. You think he can?
It's
You
tough
think
though
he's going to
because
stand up on the
inflation's going
podium
higher too.
and
Like
not once address the fact that there's fucking shit going on in the credit markets?
I think that one of the problems though is you're looking very closely. And if you step back and think about it in a grand scheme of things, it's not as bad as you think. And for example, issuance, I think that they just had the largest issuance ever on a single day in corporate credit. So the markets are open. It's no, and yes, the prices were extremely tight and they're widening, but that's what markets are supposed to be. And in the grand scheme of things, Patrick, they're not that wide.
Okay.
So I get it. You want to be short credit, and it's one of my, it's actually my largest position right now is short credit. But you do not want, I don't think it's at the stage where it's going to cause the Fed to react. I think we're a long way away.
All right. So Kev,
yeah,
we have to pause for a moment and just recognize that we are several hours into the show, like a stone throw from the close, and we haven't talked oil yet.
I know, but everyone's talking oil. I feel like there's not much. And the other thing is, Patrick, there's so much volatility there, and it's such a news-driven headline that we do this, and then 2 days from now it'll be useless.
But what I want to pivot to is not actually just crude, but the knock-on effect or implications for energy stocks. So obviously, crude can be at 150 on one headline and it can be down below 70 on another. And so maximum volatility, there's a reason the implied volatilities on crude oil are at 111%, whereas high as 25%, like insane implieds. Even on the weeklies, you're talking 170, 190% implieds on oil, like just insane levels of implied. And rightfully so, it's there. But what's interesting is that the energy stocks were rallying under their own sector rotation thesis for months in advance. And generally, let's say the XLE hasn't really done anything during this period. And now the question I have for you, what's your speculation? Like, has basically all of the best possible scenarios already been in some degree or another baked into the cake? Or is it that there's a lag here that's going to give these a kicker?
Oh, you mean the fact that the stocks haven't rallied as much as you'd hoped?
Yeah. Well, not that I hoped, but just like they haven't responded. It is what it is.
In terms of this last 2 weeks?
Yeah.
I think, though, one of the things you need to remember is on a relative basis, the whole market's down now. So, yes, I hear you that it hasn't moved that much, but let me just pull this up and let's look at the groups. Because my suspicion is, what was the day of the war? Like, basically, it was over the weekend. So it's like, if we look at this from February 28th, like that'll work, right? Let me just pull this up. So the 27th, I'll do the 27th. So yeah, every index is down, except for energy index, the energy index, which is up 2.5%. So sure, it's not screaming to the upside, but materials are down 8, industrials are down 7, healthcare is down 6, staples, consumer staples down 5, financials down 5 almost, consumer discretionary down 4, and energy's up 2.5. So I think it did what you wanted to do. It's tough when beta is getting sold and the reality is that the stock market is getting liquidated. It's tough for it to go up. I'm not fussed. I think it's done great. Like it won't. The other thing, Patrick, is that for a while now, almost all of the action in the oil market has been at the front end of the curve, and that the curve in terms of a month out a year out and farther, it's not really moving. Now it's starting to change, but when you think about stocks, they're not pricing it based upon the front end of the curve. That's not what they're getting. Right. Like, often what you're pricing, and not only that, what you're really thinking about is their assets in the ground. What are they worth over the long run? So what you need to do is compare it to long run price of oil. So if you look at 1 year out, what that oil is, and I think I've done this before. Actually, a lot of times these things will follow like the 5 year out price of oil. That's what they'll trade on. So I'm not fussed at all. I think
Okay.
that they've done quite well.
So, the next thing I just wanted to make sure we just cover all the charts here. Um, Gold, uh, everyone was, at least I've heard of many people talk about that their expectation was in geopolitical uncertainty. They were expecting gold to behave in almost like a safe haven manner and rally. And really, gold's been grinding. My position has not been that. But overall, my position was that in the past, gold, after a blow off top, has spent as much as 2 to 4 months consolidating before bullishly breaking out again. And we're just like 40 days into a consolidation, and us, retesting the 50-day moving average and trading back to the top of the trade range and messing around here is the base case. But the one thing that I want, first of all, do you disagree? But number two, if we had a stock market liquidity event, like a washout, kick the feet out from underneath the market, it's dipping to the downside. If something like this is underway, what's your over under that gold gets grabbed by the ankles and dragged down in some liquidity selling, even if it's short term and a buying opportunity as a result?
Oh, I'm almost positive it will. Gold is behaving like a risk asset right now. And if we have a massive U.S. Stock market sell-off and credit event, especially if one where the front end of the yield curve is going up because oil's going up, I mean, the front end of the yield curve's yield is going up and the price is going down, gold's going to go with it. And it's only once we get to the stage where the market starts to smell that the Fed is going to turn and is going to provide the liquidity that is needed, at that point it'll rip. So it's one of these things that you need to be careful about. It could be 2 days and it could be $500 on gold, but then it's very quickly, that is what you want to buy on dip. So everyone's talking about buying the dip on the stock market. I'll take a pass on that. I'm going to buy the dip in gold. When we get a serious correction in gold, you want to be there because it will be the thing that leads us out of the next recovery.
All right. So listen, the last thing I want to touch on here, because we're running way over time. So let's just leave it one thing. We got to talk the grains and ags. Yeah. Because the one sector that doesn't show up on your sector analysis with the energies is the ag space. But here you have corn ripping to fresh new multi-month highs, soybean at 52-week highs, wheat at 52-week highs, all ripping, while you have the MOO index, which is the ag basket, ripping to the upside. But while the MOO has not beaten February highs, shitloads of the individual names, Nutrien, fresh new highs, CF Industries, fresh new highs. Like you could go, Bunge, fresh new highs, IPI, which is the IPI, Intrepid Potash, fresh new highs. Like we have a huge ag bull market. I know a good friend of the show, Paulo Macro, has been all over this for a while.
He's huge.
But this has been a place that's getting lots of love right now. It's like it ain't noticing no Middle Eastern.
No, it's actually going up because of the Middle Eastern nervousness. A lot of the ingredients needed for these fertilizers comes from there. And so the whole world is short fertilizers, and that's why these things are occurring. So one of the troubles with this trade is if all of a sudden, and I don't think this is going to happen, but let's just imagine that there's a new Iranian leader that says everything's great. We're going to let all traffic go through. We've made a deal. It's terrific. These things all come back big time.
Okay.
So just be aware that this is more of a geopolitical angst trade than you might.
But now that's the stocks or the actual grains?
Well, the grains are up because they're anticipating there's not going to be as much fertilizer available. And so yields will be down. And people need to realize that, over the many years or decades, almost centuries of us getting more and more efficient with our farming, a lot of it is this fertilizer. And if we get a situation where all of a sudden there's not enough fertilizer going around, we could have squeezes in the grains and in the commodities themselves that are quite scary. And we go back to the problems with when we were talking about the consumer and them getting squeezed. What if they're getting squeezed not just on oil? What if they're also getting squeezed on their food? And that's where we're headed right now. And you touched upon it when you said the Iranian regime wants to cause as much economic pain as they can. One of the ways they can do that is by making the price of food more expensive.
Absolutely. All right. Well, Kev, listen, I think this is where we can wrap things up. So let's bring this to a close.
All right, Patrick. If everyone, thanks you very much for tuning in. And Patrick, you know, in this trying times with markets all over the place, you got this great webinar coming on Monday. Remind people about it, where they can go, what it's going to be about. Give us the whole spiel.
Well, you know, Kev, what's interesting about the last time I did a hedging special webinar? You know when it was?
Was it right
the
at the
day
top?
before Liberation Day.
Oh, really?
Absolutely. You know, the thing is that whenever markets get turbulent, I often want to kind of always take a moment to, remind members and listeners just, how important it is to hedge and the benefits of being able to dampen downside volatility to give you staying power in the markets and be able to ride out some difficult times without making the only choice to just go to cash. And so a lot of these big institutional desks are always talking about hedging with bear put spreads, like, doing a 95 by 85 bear put spread out and things like this. And I want to be able to go deep and explaining what it means, how you size these trades, what impacts it would have if there was a downdraft in the market, and what impact it have on a portfolio. I want to be able to explain to our listeners just how to protect your portfolio, not by selling everything, but rather just simply having a volatility dampener, something that reduces the drawdown and gives you more cash at the end to be able to buy dips on. So I'm doing this special webinar on Monday. I'm going to be on March 16th at 4 p.m. Eastern time, and you just have to go to bigpicturetrading.com to check it out. There's the registration right on that homepage, and it's completely free. Because I have a view that if I can just show people how these things are done and they make get some value out of it, then they see the value of being a member. So come on, join me for that webinar. It's going to be a great opportunity to go deeper on this.
Sounds great. All right. Bull market, bear market, we're just happy to spend some time with you. Now stick around for the after show. Danny, okay, I got something to say. So I was watching on our little, I don't know, what is it? Screen with all of our different views that we have. I see Danny kind of off to the side. It's like in the, what do they call it? The green room or something. And he is drinking water. And it looked like the biggest jug of water I have ever seen in my life. So, Danny, can you bring it up so I can see it? Because it was all grayed out. And I don't know if it was just the angle. Oh, my God. Yeah, so he was drinking out of this thing. It's like a 3-liter, maybe a 4-liter bottle. That's how that guy rolls.
You got to stay hydrated. This is important. Like you can't fuck around with just small little 250 ml little toys. Like you got to go 3 liters. It's got to
go big or go home. That's what I say.
Yeah, that's right. You know what it is? I hope you don't mind this, Danny, for us mentioning this, but you bought yourself a new camper van, so you're living life large, and now you're springing for the 4-liter bottles of water. Like you're wow.
What can I say? Nothing. You're completely right. Big time. I mean, I've hit the big time.
You hit the big time. Patrick's driving around in Ferraris and jumping out of balloons or whatever, and Danny's getting the 4-liter bottle of water. Yeah. Okay, let's get the beer review before we, forget.
You know what? This is a hazy IPA. My head is spinning. It's a 6%er. I'm not drunk, but it definitely, I can feel that I had a beer, and it's awesome though. I'm going to rate this one 7.8. I recommend anyone who wants to try a Square Wheels. It's like Square Wheels makes sense. It's like being long the market right now. You're gonna
it's tough plugging. It's tough to roll with the
it's tough to roll in this market. But it's a great beer. Love it.
That's great. All right. Anyone have anything apart from Danny's big purchase? Anything new and exciting happen in anyone's lives?
Oh, you know what? I'm actually heading back across the Atlantic here next week. And
You're gonna come visit me, right? We're gonna go up for
we're gonna get it. But I'm gonna also go and visit Cuppy. I'm going all the way down to Puerto Rico.
You're going to Puerto Rico, Casa Su Cuppy.
Yeah, absolutely. I'm gonna go help him pick some mangoes.
Well, you know what? He's going to put you to work doing some farming in the back. Like, because I don't know if anyone follows him on Twitter, but if you do, you know that he is very into farming. He's often off, tending his land for the coming apocalypse. And, sometimes he comes on to like the chats and he's like, what the hell happened? I was busy like planting my mango trees or whatever. And we're like, dude. And then you can see his cow. I think there's a cow that the farmer left next door or whatever. So you're going to have to give us an update. It's going to be a lot of fun to hear about what it's like living with Cuppy.
Yeah, absolutely. I'm actually just looking forward to hitting some waves down and do a little bit of surfing.
Oh, that'll be great.
It'll be awesome. I'm looking forward to it. But we'll definitely meet up for a nice dinner.
Oh, that sounds great. How about you, Danny? Are you enjoying the new ride?
Yeah.
So when you say camper van, I'm not familiar with that term. We use different words. So what is how big is it?
Motorhome.
Oh, it's like a full-on motorhome. Okay,
it's a retirement wagon.
Okay, I got it. The kind that the guys Top Gear flung off the cliff.
Yeah.
Okay, I got it. Looks very nice, very chic.
I'm jealous. I'm seriously thinking of getting one because this guy's roaming across Portugal, checking out these beautiful beaches, and it's
Well, I mean, thankfully we bought this one because it has a big garage space, so we've managed to fit 2 surfboards in the back.
Oh, that's awesome. Oh, that's terrific. Are you going to tow a little car?
No. This is the car.
This is the car, but because sometimes you can't get into some parts of the city and stuff. It's like kind of a pain in the ass.
Yeah, but it's more for being outdoors. It's not necessarily.
Oh, I see. Okay, you're just gonna go from one beach to the other. One beach to the other. Got it. Exactly. Okay, well that's great. Everyone, thanks for tuning in, and we'll see you next week.
Cheers, everyone.